If you want to know how much money you need to make to afford a $1 million home, you've come to the right place. Stay tuned because we'll show you exactly how much you need to make based on your location and other details regarding the home. We'll also show you a few tips along the way that will help you decide if a $1 million home is right for you. Let's get started. Depending on where you're shopping for a home, $1 million could get you a spacious mansion or just your typical single-family house. For example, in the Los Angeles area, the typical home costs nearly $1.15 million. In Chicago, however, it's under $400,000, meaning $1 million could go pretty far in terms of amenities and square footage. Regardless, the price tag is the same, and so is the cost of taking out a mortgage. Exactly how much money would you need to make to afford that $1 million house? First, let's briefly cover the income needed for a $1 million home. Then we'll get into some important rules you should consider. Some general rules apply when shopping for a home. These require knowing how much you make each month, both before taxes and after, and the total of any other debts you pay monthly. Knowing this helps lenders figure out how much you can afford to repay each month. Here are a few different but common rules mortgage lenders use when deciding how much you can borrow. The rules refer to the percentage of your income you should put toward mortgage payments. The 28-36 rule states that you should spend no more than 28% of your monthly pre-tax income on your housing costs, and no more than 36% on debts in total. So if you make $8,000 per month before taxes, your total housing costs, including mortgage payments, interest, homeowners insurance, the 35-45 rule states that your total debt payments should not exceed 35% of your monthly pre-tax income, or 45% of your monthly post-tax income. Let's say you have an annual salary of $100,000. Under the 35% of pre-tax income rule, you would have $2,380 to spend monthly on debt payments. Under the 45% of post-tax income rule, you would have $2,674 to spend monthly on debt payments. So assuming a 20% down payment, a 30-year loan term, and a 6.5% interest rate, a $1 million home would require a $5,057 monthly payment toward principal and interest. Homeowners insurance and property taxes will also make up your payment, but these vary depending on where you buy your house. For this example, let's say homeowners insurance would cost $150 a month, and property taxes would be an additional $1,500 a month. That's a total of $6,707 per month. Now let's see what salary would allow you to make this payment under the above rules. We're omitting the 25% rule, as tax scenarios can vary widely. Remember that the above numbers only take into account the amount of money going toward your housing payment. Your best bet is to look at your salary and monthly debts and multiply them by all of the above ratios. This will tell you if you'd likely be able to qualify for a $1 million home purchase. Let's take a look at various salary ranges and whether they would allow you to make the $6,707 payment under the above rules. If you were using the 28-36 rule and made $78,250 per year, then you would be able to make the $6,707 monthly payment. You would be maxing out your 28% of pre-tax income on housing, and you would also be maxing out your 36% of pre-tax income on debt payments. You'd be left with nothing to spend on other expenses like food, transportation, and savings. If you were using the 35-45 rule and made $100,000 per year, then you would also be able to make the $6,707 monthly payment. This would max out your pre-tax income at 35% and your post-tax income at 45%. Again, you'd have nothing to spend on other expenses. Using a quick math equation, you can determine how much money you need to make to afford a $1 million home. This assumes a 20% down payment, a 30-year loan term, a 6.5% interest rate, and no other monthly debts. You would need to make $93,480 per year to afford a $1 million home. What if you had other monthly debts? Well, that depends on how much you owe and what interest rate you're paying. As a quick example, If you had a car payment of $500 at 4% interest, you should also keep in mind that the above numbers assume a 20% down payment. If you can't afford to put this much down, your monthly mortgage payment will be higher. You'll also have to pay for private mortgage insurance, or PMI, with a conventional loan. PMI protects lenders against losses if you fail to make your mortgage payments. Private mortgage insurance companies base premiums on several factors, including the size of your down payment. Since you'll be putting less than 20% down on a $1 million home, your PMI will likely be quite costly. You may need to use a jumbo loan. In many cases, buying a $1 million home will require using a jumbo loan, especially if you don't have a 20% down payment. Conforming conventional loans for single-family homes only go up to $806,500 in most parts of the country. Though, there are some higher-cost markets where limits can reach into the millions. For example, in Alaska, conforming conventional loans go up to $1,209,750. If you're not in one of these high-cost markets, then you'll need to use a jumbo loan, which allows you to take out a loan larger than the conforming loan limit. Jumbo loan costs and requirements. Generally speaking, it's harder to qualify for a jumbo loan than other types of mortgages. You will usually need the following: a large down payment. While conforming conventional loans allow for down payments as low as 3%, you'll typically need a minimum of 15% down with a jumbo loan. A higher credit score. You generally need at least a 680 credit score to qualify for a jumbo loan. Cash reserves. Many mortgage lenders will require you to have at least 6 months of housing payments saved up in case you lose your job or hit some other financial snag. A low debt-to-income ratio. You will usually need a DTI ratio of 45% or less for a jumbo loan, meaning your total monthly debt payments, including your projected mortgage payment, total a maximum of 45% of your monthly income. Using the above DTI ratio, this would mean a borrower with an annual salary of $200,000 would have about $7,500 to work with each month, minus any other debts they owe monthly. A quick note: jumbo loans tend to come with higher interest rates than other mortgage loan types. So using one could mean a higher monthly payment than you would see otherwise. This will also impact what salary you need to afford a $1 million home. Get personalized help. Many variables impact the cost of your monthly mortgage payment. These include the lender you choose, the home's location, your loan type, and other factors. For the most accurate idea of what salary you need to buy a $1 million home in your area, talk to a mortgage professional. They can run the numbers specific to your financial situation and help guide you toward the right home buying strategy. A mortgage broker can act as the middleman to find a mortgage lender that uses the DTI ratio rules that benefit you. You can also contact a loan officer at a specific lender or apply for mortgage pre-qualification to find out if you earn enough money for a loan on $1 million Australian dollars house. Your real estate agent usually has a good idea of your financial situation before starting the house hunting process, so they may know how much house you can afford and even which lenders would be best. Buying a $1 million home is definitely possible if you plan carefully. It's important to know how much you can realistically afford without stretching yourself too thin financially. Use the information provided to get pre-approved for a mortgage. Calculate what you can afford and start saving for a down payment. What do you think? Is a $1 million home in your budget? Comment below. And if you found this video helpful, give it a like and share it with friends who might be interested in buying a $1 million home. Don't forget to subscribe for more expert advice on mortgages, real estate, and personal finance. Thanks for watching.